Well, Amazon rounding out a jam-packed week of big tech earnings. The company delivering a better-than-expected operating margin, while CEO Andy Jassy touts AI as the future of the company's financials. But when looking at results from tech giants such as Microsoft and Alphabet, the big picture for tech becomes unclear. Here to help decipher this week of big tech results is Brad Erickson, RBC Capital Markets Internet Analyst. Thank you for joining me this morning. So, a very busy week, obviously, as we saw here. Interesting when Amazon entered the chat, especially when it came to AWS and the cloud conversation here. Talk about the key takeaways then for bears and bulls off of Amazon.
Yeah, thanks for having me. Yes, thank gosh it's Friday. It has been a trying week in big tech earnings. Yeah, I think for Amazon in particular last night, the over under for the stock, and of course the reason it's up today is because Amazon wasn't as bad as feared, and importantly, I think directionally from here, it's likely to get better. It's not likely to get worse. Now, the bulls need to see material reacceleration in the next year. Just to give you a little numbers, we did 12% in Q3. We think it's going to be just a touch faster than that in Q4, and then accelerating more materially, at least to the mid-teens, call it 15, 16% for full year 24. I think if you're a bear, you think we're going to stay in this broader theme in cloud of optimization, which is a fancy way of saying customers finding ways to spend, maybe not increase their spend so much. I think if you're a bear, you kind of think that's going to continue. You probably have a view that Microsoft is gaining share and that Amazon's not going to hit those numbers next year.
And so with that in mind, we're talking tens of billions of dollars there that Jassy is saying with this AI bet. Are you as convinced at this point? Because it's still very early days at this point.
Yeah, no, I mean, I think based on what they've shown to date, I think there's a lot of evidence to support that they're on their way. Certainly from a product perspective, Bedrock is really the key product here. It's a way, think of it as offering a menu of these large language models. No one model is going to be the perfect fit for everybody. And so I think Amazon's taking that open source approach, and they spoke to seeing a lot of good evidence and traction of that strategy at this point. He also made one really interesting comment, we thought, where he said that he implied that Amazon favorably compares to other public companies that have disclosed Gen AI run rates, which of course would be Microsoft primarily, almost implying that they're larger than Microsoft at this point. So we found that point pretty interesting. But no, I think the tens of billions of comments, the tens of billions of revenue comment, that's more of like call it a cumulative 3 to 5 year comment. So we can't really peg to the numbers so easily, but I do think they're making really good progress. And yeah, we're bullish on that opportunity for them going forward.
And we did know that investors were going to be looking for some of this proof of all this generative AI that a lot of companies touted in the last quarter. But looking at Google Alphabet, still under pressure, and that's after an earnings and revenue beat, and advertising gains as well. But the street really focusing on that cloud revenue falling short and what they were hoping to see with the monetization of AI. But do you think the stock is being unfairly punished today?
Sorry, we were talking Alphabet, I'm assuming. Is that right?
Yes, to see if it was unfairly punished, given how well the earnings report was, but the focus on cloud.
Yeah, I got it. I would say so. I mean, the advertising business, we do a lot of channel checks in the ad space. We came in tactically constructive on the space where everybody hit numbers or beat numbers really for Q3. Meta's guidance was fine for Q4, even including some impact they called out from the Middle East. Google had an unfortunate quarter with the cloud business, and it sort of brought everything else down. And with the Meta result on Wednesday, I think the takeaway there was, unfortunately, people were looking for kind of any reason to sell the stocks. I think that's probably a reflection on the broader macro where we think the consumer is going, but kind of looking for an excuse to sell the stock almost, and just made it a tough week until today with Amazon, fortunately.
And so speaking of Meta, then obviously 2023, the year of efficiency, seemingly paying off at the moment. Obviously the metaverse play, if we look over the past 5 years, still seeing some losses there. What are your expectations then for 2024 based on some of the cuts we've already seen Meta making this year?
Yeah, I think it's going to be a combination of things. And you kind of point to three factors that really drive the operating expense guidance they gave, which was modestly better than expectations. Number one is just in general around headcount costs, facilities costs. I think there the message is, yeah, 2024 is going to continue to be another year of efficiency. That's number one. Number two is just on their capital expenditures. These are around, building data centers and buying servers and certainly graphics processors in the age of generative AI. I think there, what we learned on the call, which was positive, was that they've actually gained a lot more, they've covered a lot more ground with money they've already spent, I think, than people realized. And so they're not going to have to spend quite as much as people thought in 2024. And then the last one is metaverse. And I think there, we don't love the losses. Investors don't love the losses, obviously. They're clearly continuing to spend. But I think the takeaway, again, nets out positively in that Mark Zuckerberg and his team are clearly acquiescing to investors' desires to keep it more reasonable, meaning balancing the growth with that spend, and you're netting out to a still an attractive consolidated P&L.
And Brad, just quickly, we saw the Nasdaq fall into correction territory this week. The S&P also flirting with that at the moment. What do you think are the best tech stocks to earn right now, especially if we're bracing for further downside?
Yeah, I think you still have to largely point to the large cap space and the mega cap space in the case of what we cover. I think Meta still stands out to us as the most. It's got the most company-specific drivers, both product-wise and sort of advertiser tool-wise, that they're rolling out over the next few years to gain share in the ad market, drive operating leverage, earnings growth at a reasonable multiple. So we definitely like that one. And then secondarily, Google has sold off, and so inherently there's a more attractive entry point than where we started the week. But I think in Amazon's case, there's probably more of an attractive upside opportunity to earnings over the next couple years. And so that one probably also has re-rate potential written all over it. In these moments, small and mid-cap companies have just been very difficult because they don't have the earnings support. They don't have the shareholder support to weather some of these more difficult periods in the macro. We like some stocks in more defensive areas. Web design would be an example. Wix would be a small cap company I would call out that we like. But aside from that, we have to be really selective because people are, the investors right now are just so sensitive to any signs that the consumer might be slowing or small business might be struggling or what have you. It just makes it really tough and makes mid-cap internet filled with a fair amount of landmines.
I certainly appreciate you breaking that down for us and really the specifics of what people should be looking for. Brad Erickson, RBC Capital Markets Internet Analyst, thank you so much. Have a great weekend.
Thank you. Good to see you.